So, in the first quarter of this year, Synchrony Financial saw their total active accounts actually shrink,
Right.
which, normally is a red flag. Yet somehow their net earnings jumped to $805 million.
Yep.
And their transaction volume hit an all-time record-breaking high of $43 billion.
That's wild.
It is. Today, we are looking at how a financial giant pulls off, well, kind of the ultimate paradox, right? Making significantly more money off fewer people. Welcome to the deep dive.
Glad to be here.
So we've got our hands on the official Q1 2026 financial results, their earnings presentation, and the press release from Synchrony.
The primary sources.
Exactly. And our mission today is to look beyond those dense spreadsheets and decode what a massive, $100 billion loan portfolio, what that actually tells us about the health of the American consumer.
Because it is a direct reflection of real-time macroeconomic trends. It's not just corporate finance.
Right. It's about where you are actually spending your money, the hidden mechanisms of those credit cards sitting in your wallet right now, and how a top consumer finance company navigates what is honestly a notoriously tricky economy.
Definitely.
Okay, let's unpack this, because the top-line numbers are telling a story that completely defies usual retail logic.
They really do. The initial figures paint a picture of highly concentrated growth. Like you mentioned, Synchrony reported net earnings of $805 million.
Which is what, $2.27 per diluted share?
Exactly. And to put that in perspective, in the same quarter last year, those net earnings were $757 million.
Okay, so a very solid year-over-year profit jump.
Right. And that jump is happening right alongside that record $43 billion in purchase volume, which is up 6%. But, and this is the key, the underlying mechanics of that growth are what really deserve our attention.
Yeah, that is the part that demands scrutiny, honestly. Because you have a 6% jump in purchase volume hitting an all-time high, but the average active accounts decreased by 1%.
Down to 68.8 million.
Right, down to 68.8 million users. And to add another layer to that weirdness, total loan receivables remain entirely flat.
Yep.
Sitting right at $100.1 billion.
What's fascinating here is that it forces us to rethink the traditional growth model of consumer finance.
How so?
Well, the management team's data indicates a very specific shift in consumer behavior within their ecosystem. We aren't looking at a broadening of the consumer base through, massive new customer acquisition campaigns.
Like spamming mailboxes with pre-approval.
Exactly. Instead, we are looking at a deepening of the existing base. The customers who are holding active Synchrony cards are demonstrating a significantly higher spend per account.
It's like a restaurant where fewer tables are seated, right?
Yeah.
But every single table that is there is suddenly ordering the expensive steak and like a $200 bottle of wine.
It's a great way to put it.
The head count is down, but the register is ringing louder than ever. But I really want to linger on the flat loan receivables for a second. Total loans sitting flat at $100 billion, while purchase volume spikes 6%. That tells me something very specific about the velocity of this money.
It tells us the payment rates are keeping pace with the spending.
Okay, meaning they aren't just racking up debt they can't pay?
Right. Consumers are swiping for larger amounts, which drives up that purchase volume, but they're also directing enough cash flow toward their monthly statements to keep their total outstanding debt from ballooning.
Got it.
It is a really rapid cycle of borrowing and paying down. The balance sheet isn't inflating with carry debt. The money is just moving much faster through the system.
So if you have a slightly smaller pool of consumers spending way more money and paying it off fast enough to keep overall debt flat, the immediate question is, where is this increased velocity actually being directed?
And to map that out, we have to look at the specific retail and healthcare platforms where Synchrony is basically embedded.
Right, because they are everywhere.
They are. In just this first quarter alone, they secured over 15 new or renewed partnerships. Yeah. Their diversified and value platform saw a purchase volume jump 9%.
That's huge.
And their digital platform grew by 8%, driven heavily by refreshed value propositions. But it's the health and wellness platform, which grew by 3%, that I think reveals the most strategic maneuvering.
Yeah, the specific partners they are targeting there show a very aggressive integration strategy. Like, they renewed their partnership with Miraclear,
Right.
locking in over 400 audiology clinics.
Yep.
And then, completely switching gears, they added Indian Motorcycle.
Talk about different demographics.
Right. And they extended with Harbor Freight Tools, offering that private label setup where shoppers can choose between, 5% back or zero interest
A
installments.
classic value play.
Exactly. And then their health and wellness arm, Care Credit, just expanded to be accepted at Walmart.com and all physical Walmart and Sam's Club locations.
Which is massive for scale.
Huge. And they even pushed Care Credit deep into the pet insurance space
Yeah.
by partnering with Figo and Embrace. They instantly gained access to over 1.7 million pets.
And you have to look at the underlying utility of those distinct partnerships. By intertwining their financing with everyday health, value retail, and discretionary hobbies, Synchrony essentially transitions from a luxury financing option into a daily utility.
Yeah, the sheer variety is massive. I mean, think about it. You have the exact same underlying balance sheet financing a brand new Indian motorcycle, a shopper's heavy-duty drill press at Harbor Freight, a patient's hearing aids, and literally a family dog's emergency surgery.
And that variety functions as a structural safeguard. I actually view their portfolio as sort of a financial suspension bridge.
Okay, I like that. How so?
Well, if the macroeconomic winds shift and the cables supporting discretionary spending like that high-end motorcycle go slack, the cables supporting absolute necessities like audiology or an emergency vet bill, they pull the tension and keep the entire bridge stable.
That makes total sense, which perfectly explains the data coming out of their home and auto platform right now.
Exactly.
Because the source material notes loan receivables there dropped by 4%.
Yep.
With purchase volume completely flat. And management cited selective spend in home improvement. Basically, people are holding off on big kitchen remodels.
Right, they're waiting.
But because that financial suspension bridge is supported by digital growth and pet insurance and tools, a sudden slowdown in consumers remodeling their homes doesn't drag down the entire portfolio.
It contains the volatility to a single sector. But capturing the transaction at Harbor Freight or the vet clinic is really only the first half of the equation.
Right. Getting them to swipe is easy.
The real stress test of a $100 billion portfolio is whether those diverse consumers actually possess the capacity to pay off those larger bills.
Yeah.
High purchase volume on paper is totally irrelevant if the back end of the operation is quietly hemorrhaging capital from defaults.
Absolutely.
We have to examine the credit metrics to see the actual financial health of this transacting base.
Let's do it. Let's pull apart those credit metrics because the numbers here provide the clearest lens into Synchrony's underwriting discipline.
And they are striking.
They really are. Net charge-offs, meaning debt they just aren't going to collect, dropped to 5.42%.
That's a massive drop.
Yeah, it's a 96 basis point drop from the 6.38% they reported in the exact same quarter last year.
And a drop of nearly a full percentage point in net charge-offs on a portfolio of this size. I mean, that represents hundreds of millions of dollars in preserved capital.
Now, we do see a slight divergence in the early stage versus late stage delinquency metrics.
Right, the 30 versus 90 days.
Yeah. Loans that were 30-plus days past due ticked up slightly to 4.54% compared to 4.52% the year before.
A tiny bump.
But loans that were 90-plus days past due actually dropped to 2.28%.
That specific divergence is a fascinating behavioral indicator.
What does it tell you?
Well, an uptick in the 30-day bucket combined with a drop in the 90-day bucket suggests that while slightly more consumers might be experiencing temporary cash flow hiccups.
Like missing that first payment cycle because things are tight.
Right, exactly. But they still possess the financial resilience to cure the delinquency before it spirals into severe default.
They catch up.
They catch up. The underwriting models are clearly filtering out the systemic risks. They are lending to people who ultimately pay.
And the direct result of that filtering is a massive drop in the provision for credit losses. That provision actually decreased by $156 million, landing at $1.33 billion.
Wow.
That is $156 million flowing directly down the income statement.
It fundamentally reshapes the profitability of the entire quarter, driving the net interest margin, the N, up by 76 basis points to 15.50%.
Here's where it gets really interesting, though. I want to challenge this net interest margin jump for a second.
Okay, let's hear.
A 15.50% NM is robust, no doubt. But the earnings report explicitly notes that lower benchmark interest rates drove down Synchrony's interest expense by a full 11%. So my question is, are they just coasting on a lucky macro tailwind where the broader rate environment just happened to lower their liability costs? Or is this 76 basis point expansion actually a reflection of deliberate strategic execution?
Well, you can't ignore the macroeconomic help. You just can't. Lower benchmark rates undeniably reduce the cost of their liabilities, which provides an automatic mathematical benefit to the margin.
Right, it's cheaper for them to borrow.
Exactly. But assuming it is purely environmental luck ignores the structural mechanics of their partnership model.
Okay.
The proof of deliberate execution and the strict credit discipline that their CFO Brian Wenzel was emphasizing, it's sitting right there in the retailer share arrangements.
The RSA.
Yes.
Yes.
The RSA jumped 20% to $1.1 billion in Q1.
A huge jump.
Can you break down the actual mechanics of that? Why does a massive payout to corporate partners signal strategic success rather than just, an inflated expense line? Sure. So the retailer share arrangement functions as a sort of profit-sharing thermostat. It aligns risk and reward between Synchrony and its partners.
Okay.
When Synchrony establishes a credit program with a brand, the agreement stipulates that the economic success of that specific program is shared.
So if the program does well, everyone wins.
Right. And in this quarter, because the net charge-offs we just analyzed plummeted so significantly, the programs retained far more capital.
Wait, so the lower defaults essentially funded that 20% increase in payouts?
Precisely. Synchrony managed the credit risk so tightly that the resulting excess profit triggered higher payouts under the RSA agreements.
Wow.
And this is how you build a nearly impenetrable moat around your business.
Because the partners are thrilled.
Totally thrilled. When you approach a retail partner and hand them a 20% larger profit share check purely because your proprietary underwriting kept defaults to a minimum, you cement that relationship.
The retailer wants volume. Synchrony controls the risk.
Exactly. And the RSA ensures both parties are heavily incentivized to maintain the partnership.
It kind of transforms the retailer from a mere merchant accepting a card into a quasi-beneficiary of Synchrony's lending discipline.
That's a great way to view it.
And this trifecta record purchase volume, expanded margins from lower interest expenses, and plummeting defaults, it's generating a staggering amount of excess capital.
And the primary indicator of a management team's long-term outlook is how they deploy that excess capital.
Right. And they are deploying it heavily. In Q1 alone, they returned $1.0 billion to shareholders.
$1 billion in one quarter.
Yeah. That breaks down into $900 million in stock buybacks and $104 million in common stock dividends.
But the forward-looking allocations are where the strategy gets really aggressive.
They announced a planned 13% increase to the quarterly cash dividend, right? Bringing it up to $0.34 per share starting in Q3.
Yep. And the board of directors approved a massive new $6.5 billion share repurchase program.
And the structure of that specific buyback program is highly unusual. It really warrants a closer look.
It does.
Because it replaces their old program. But this new $6.5 billion authorization was issued with absolutely no set expiration date.
Which is very rare.
Super rare. Standard corporate practice is to authorize a buyback over, a 12 to 24-month window?
Usually, yeah.
A perpetual, open-ended authorization of that magnitude feels like management writing a massive blank check for their own stock. Why remove the time limit?
This raises an important question about how they view the market. By stripping away the expiration date, the executive team is engineering ultimate flexibility and leveraging market psychology.
Okay, unpack that psychology part.
While a hard deadline often forces a company to execute trades regardless of market conditions, sometimes that results in suboptimal purchase prices just to, fulfill the authorization before time runs out.
Oh, because they're on a ticking clock.
Exactly. An open-ended program telegraphs a very different message to Wall Street. It states unambiguously that management views the stock as undervalued, possesses the liquidity to acquire it, and will opportunistically step into the market whenever they determine the pricing is advantageous.
It establishes a psychological floor under the valuation.
Exactly. It projects an extreme level of internal confidence in the durability of their balance sheet.
And CEO Brian Doubles made a very deliberate point in their earnings release to link this financial output directly to their internal organizational structure.
He did.
He highlighted that Fortune magazine just ranked Synchrony as the #1 best company to work for in the U.S.
#1.
Yeah. And he argued that their high trust culture actually allows them to execute faster for their partners.
And, it is easy to dismiss a workplace ranking as a soft tertiary metric. Just corporate PR.
Right, like who has the best ping pong tables in the break room?
Exactly. But in a complex financial services operation, culture is a hardcore operational variable.
How so?
High employee retention translates directly into institutional memory. When you're negotiating billion-dollar retailer share arrangements or tweaking incredibly sophisticated underwriting models to drop charge-offs by 96 basis points, you rely on specialized talent.
You can't be retraining the underwriting team every 6 months.
You can't. Low turnover ensures the continuity of the very strategies that produced this quarter's excess capital in the first place.
So what does this all mean for you as you navigate the current economy?
It's the big question.
If you strip away the billions in loan receivables and the basis points of margin expansion, Synchrony's Q1 2026 performance is really a masterclass in modern corporate resilience.
It truly is.
Whether you are a consumer evaluating a zero-interest installment plan at a hardware store or an executive trying to bulletproof your own business model, the takeaway is the same.
Yep.
Synchrony demonstrated that massive profitability doesn't require endlessly acquiring millions of new users. It requires building deep, indispensable utility for the users you already have.
Embedding your service into their pets, their healthcare, their daily retail habits.
Exactly, and enforcing a relentless, disciplined approach to managing risk.
And the numbers clearly indicate that the strategy of depth over breadth, when combined with rigorous underwriting, is producing record-breaking volume.
Without a doubt.
But it also introduces a crucial question about the trajectory of the broader economy.
Okay.
We are looking at an environment where purchase volume is hitting all-time highs of $43 billion, driven entirely by existing accounts spending more, while the overall number of active accounts is quietly contracting.
Right.
So if a massive institution can generate its highest profits by managing a slightly shrinking pool of highly active, reliable spenders, you have to ask yourself what happens to everyone else.
Yeah.
Are we witnessing the quiet beginning of an era where access to consumer credit becomes intensely concentrated, where the economic incentives drive banks to cater exclusively to a smaller, wealthier tier of superspenders, leaving the average consumer with progressively fewer options to finance their lives?